France's Marine Le Pen makes further demands to the budget after the Prime Minister makes a major concession as the government's survival hangs in the balance. The yen strengthens, breaching 150 against the dollar as traders position for a possible rate hike from the BOJ next month, at the same time as a cut from the Fed. And reports also suggest that Iran will hold talks on its nuclear program and uranium enrichment plans today with European nations. So we'll have a full roundup of geopolitical news. We look into next week and quite thin trading volumes because of Thanksgiving yesterday in the U.S. So a lot of the stocks and also treasuries were closed. They're reopening today. The markets map overall, a bit of pressure, not huge, but if you look at the CAC 40, the DAX and the FTSE down 0.1%. If you look at some of the concerns over the last couple of days, I'm looking at technology stocks and they're actually leading the advance. There's quite a lot of hope that the U.S. curbs on chip equipment sales to China may actually prove lighter than feared. A couple of the other things we're watching, U.S. 10-year yield 42187. France will have a full conversation actually on the political implications of France and what to look out forward. You can see yen 150.19, and then on the back of geopolitics in the Middle East, that ceasefire with Lebanon, but also conversations with Iran, Brent 72.83. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So Marine Le Pen's national rally is demanding further changes to the French government's 2025 budget bill after the Prime Minister Michel Barnier dropped plans to raise taxes on electricity in a key concession. Let's bring in Alan Katz, Bloomberg's Paris bureau chief. Alan, great to speak to you. As always, we were just in Paris together yesterday. What does Marine Le Pen's party want now?
Well, they want a whole series of other things, some of which are possibly doable and some of which are not. I mean, as you pointed out, Michel Barnier, the French Prime Minister, already retreated on the increase in electricity taxes yesterday afternoon. That was already a big step, as Jordan Bardella, the number 2 in the national rally, put it in his tweet. You know, it's a victory for his party, and it is. But both he and in particular Marine Le Pen have been even more strident since, asking for basically a moratorium on any tax increase of any form for working French people, asking for reduction in medical aid for foreigners, and saying that, in fact, this all needs to be financed in some way, that Barnier needs to come up with how he's going to reduce state spending, you know, for the sort of the apparatus of the state or other ways to sort of fund these things. Now, there is, as you pointed out, I mean, Marine Le Pen essentially has the whip hand. You know, as of next week, there could be a no confidence motion against Michel Barnier, and she's really the one who's the deciding vote, and so that really puts her quite in a powerful position.
But Alan, what happens? So if Marine Le Pen's party basically says, look, that's it, there's no confidence vote, I no longer want to be part of this government, they can't go to elections. So then what happens? Is it still, so the President Macron then has to find another prime minister? Could he choose the same prime minister? What's, you know, we're going to see quite a lot of volatility and turmoil.
Yes, I mean, and you're seeing it already today, actually. So French bond yields went down a bit yesterday as the concession was going on. Then you have Marine Le Pen particularly being more strident yesterday evening, and this morning you have a small increase. I mean, it's not huge, but a small increase in French bond yields, while the rest of European bond yields are going down. So you see that there is a real impact on markets from this sort of the back and forth over this. But your point's a good one, which is that there's no clean outcome for this. France can't hold parliamentary elections again until June of next year, which means that if Le Pen were to, as you say, sort of agree to join with the left and oust Michel Barnier, then French President Macron would have to name a new prime minister. First, the budget would also disappear as a result of this. So Macron would have to name a new prime minister. When he would do that, there's no specific timing on it. He could name Barnier again. That actually happened once before in the early 1960s. But to what end? Could he find someone else? To what end? The parliamentary system won't change. And so that's one of the difficulties of this, which is that if she does force this government out, what happens then and how does it change? It's really unclear.
So, Alan, I mean, does the government actually want to find a compromise? And do you think Marine Le Pen and her party also want to find a compromise with the budget?
Do I think? That's a pretty loaded way of putting it. I'm not in Marine Le Pen's head, nor am I in Michel Barnier's head. It appears that, certainly from the government side, they're looking for a compromise. The agreement, it's more than 3 billion euros, the decision not to increase the tax on electricity, just that policy in and of itself. So they appear to be really making concessions to Le Pen's National Rally Party. Are they going to is she keeping up the pressure between now and Monday when she's given this deadline because of sort of some of the mechanics of how part of the budget needs to be passed by then? The answer is yes, she's keeping up the pressure. Would I expect the government to make more concessions in order to try to get her to agree not to go with a motion of no confidence? Quite possibly. I mean, I would be not surprised if Michel Barnier showed up on French TV on Sunday night on the 8 p.m. news shows and announced some additional concessions to Marine Le Pen. I'd have no idea if that would actually happen, but it certainly wouldn't surprise me. Would that then come to an agreement and to avoid a no confidence vote? Quite possibly. But again, it's really quite hard to tell because you really have to be in their heads about sort of, do they think they can get more from the concessions that Marine Le Pen might be able to get out of the government and from the government side of actually getting a budget? Or do they say, forget it, let's blow it all up and see if we can't do better next time?
Yeah, so interesting. They'll probably be going through the numbers also in terms of what it translates into their popularity. Ellen Katz, as always, thanks so much for joining us, our Paris bureau chief, possibly rearranging his weekend to be on top of this. Now, we're joined by Charlotte Ryland, head of investments at CCLA Investment Management. Charlotte, thank you for joining us. Look, there's so much going on that the prospect, of course, of this no confidence vote in France is also means that investors are selling French assets, driving up the country's borrowing costs compared to some of their peers. I mean, is this just one factor that makes you wary of Europe?
Yeah, I mean, I think, France is the moment the one that's in the spotlight, but I think probably a lot of the problems in France are similar ones you're getting across Europe, and that you've got an ageing population, you've got a huge debt burden post-COVID that people are trying to deal with, and you've got a lot of social promises, whether it be on pensions or on healthcare systems, that you're trying to balance out. And do you take the approach the US is doing of cutting taxes and hoping you supercharge the economy, or do you raise taxes and try and make those difficult cuts at the same time? So I think at the moment France is the one in the spotlight, but I don't think it's a unique problem.
Yeah, but so when's the right time to go into French assets again?
Well, I mean, if you're looking at the equity market, I mean, yes, we've had bond yields spread out a little bit, and the big headline was, they're yielding more than Greece. But this isn't 2012. It's not, we're, haven't got 40% yields.
Greece has done pretty well.
It's done pretty well since then. So, I mean, we're sub 3. We're paying more on debt in the UK and the US. So I don't think we're at all at any sort of Liz Truss crisis moment in terms of sort of French borrowing costs. And therefore, we've had a little bit of a sell-off in terms of some of the French assets. But actually, that's probably opening up some opportunities.
Do you like any of the European assets? I mean, Germany's also in political turmoil.
Yeah.
We're going to elections come January. It just feels really difficult.
Yeah, and in Germany, you've got a huge problem within your industrial
February,
sector.
I apologise. I need to correct. There are elections in February in Germany.
Which, again, you might see as sort of a shift towards, anti-incumbent voters, the similar kind of thing. But, I mean, the industrial sector in Germany is clearly having problems. Partly it's, the higher, quite gas costs. Is also the auto industry is in problems across Europe. I don't think those are easily solvable. But, if you're thinking about, where might be interesting assets in Europe, it's going to be more the global companies. So it's going to be, whether it be the L'Oreals or the Nestle's or the Novo Nordisks of this world, there are still some, really interesting companies.
But so would you just go to U.S. equities or U.S. companies, given also the prospect of those Trump tariffs?
Yeah, I mean, I suppose the challenge with the U.S., of course, is that it's done incredibly well already, and you're at this huge premium to the rest of the world. Now, is that supported by earnings growth and by that supportive economy? Yes, to an extent it is, but, perhaps quite a lot of that is priced in. So I think it always comes down to that nuance of the individual names.
Overall, what's your biggest concern about the tariffs coming from Trump, or coming or not coming? Actually, we don't really know if there's a starting position, but markets are moving on the back of it. Is it going to be inflationary, and will it hurt Europe disproportionately?
I mean, clearly Europe might well be in the headlines from that. I mean, China usually is public enemy number one if you're Donald Trump, but Europe is something he's been thinking about too. I mean, I think at the moment the market's probably concentrating on tax cuts, and it's concentrating on deregulation. It's taking quite positive, and it's going to take time for tariffs, A, to come in, and B, to actually have an impact on economies. But I think as you move into the latter half of next year, I think if you genuinely have a trade war, that really isn't good. But, of course, the question with Trump is, he says a lot, but what does he actually get done? What does Congress let him do? And is it just a negotiation tactic, or does he actually follow through on this stuff? And at the moment, that's very hard to say.
What does that mean for markets? Just a lot of volatility or swings?
Yeah, I think for the moment, I think you'll probably get a rally into the end of the year, and possibly some strength into next year as well. But I think that could be the exact direction of that could be quite negative, particularly given that things are quite expensive already.
All right, Charlotte Ryland, there, head of investments at CCLA Investment Management, stays with us. Coming up, we talk Japan. The yen briefly breaching 150 against the dollar as traders positioned for a December rate hike. We'll talk that, and then we'll talk a little bit more about luxury shortly afterwards. More on that. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the yen briefly crossing the key level of 150 against the dollar as traders position for a stronger likelihood of the BOJ actually raising interest rates in December. Now, we're joined by Charlotte Ryland, head of investment at CCLA Investment Management. So, Charlotte, thank you so much for sticking around. We were talking before about France, about some of the pitfalls in, I guess, domestic politics that investors are wary of. What's your take on Japan right now?
You're seeing a little bit of inflation coming through for Japan, and therefore, are we going to continue on this path towards a slightly more normal interest rate? That's certainly what the market is pricing in. I think they're saying yields will get up to about 2% going further out. So is it possible that you get, another quarter point rise from Japan, which is interesting because they're sort of ending up with everyone else in the world is cutting rates, and Japan is on this upward path. But, having after decades of zero interest rates, I suppose that's a good sign.
I mean, can we learn, again, a lot of the communication from the BOJ seems pretty clear. Can anyone else learn from that? I mean, apart from the wobble, I have to say, a couple of months ago.
Yeah, I mean, I suppose, the big worry we had earlier in the year was when we had the carry trade unwinding, and I don't think that I would expect is going to be such a sort of threat. I imagine most of that stuff being unwound now.
Do you see opportunities in Japan?
I think the big hope in Japan is that, they start to sort of have a greater focus on the returns of their assets, and they sort of get cash off the balance sheets and invest into their businesses. But that's a long process. So, I mean, you can say from a top-down perspective there's more interest there, but actually finding the individual names, again, tends to be quite difficult, and a lot of them are quite highly valued when they are those good quality companies.
But, Charlotte, when we look around the world, and I'm talking to, we kind of get you on, and we're very grateful for your time, but I always ask you, like, the hot spots that we're looking on a daily news basis. I mean, what's your holistic view on where you would deploy cash or money right now?
This has been a sort of very narrow market, and it's been a few stocks, of Nvidia being the obvious one, which have done incredibly well. But there's huge areas of the market which actually have had quite a soggy year. So, I mean, healthcare, for example, has had quite a difficult time. A lot of that's that overhang from the pandemic, particularly in the life sciences companies. More recently, we've had some worries about what does Donald Trump mean, what does RFK Jr. mean. But actually, the long-term picture for healthcare in terms of the innovation, in terms of the spending that we're going to have to see, continues to be really interesting. So I think, there are opportunities emerging there. And if you look at something like, say, Zoetis, which is an animal health company, you don't have to worry about the politics at all. They sort of carry on, producing the drugs to do. So we think that's interesting. In terms of industrials, again, if you're anything to do with data centres, so you think like Schneider Electric, you've done very well. But actually, general industrials have been much more soggy. So again, there's some opportunities emerging from some of those businesses. And then within technology, it's been all about semiconductors. Software businesses haven't done that well, but they're still, producing very good growth and very good returns. So there's,
when you look at semiconductors, I mean, this is obviously a Trump trade, actually, at the margin. So how do you protect? Is there a way of protecting yourself? I mean, do you hedge in case he goes after some of the semiconductors?
And I think there it's... I mean, ASML has been the one that's really been sort of in the spotlight in terms of trade policies. It's already seen, restrictions on what it can do within China. And I think, that has been a headwind, but you've still got that sort of longer-term picture in terms of it is the only tool for making these very complicated, very tiny semiconductors. And that demand is still there. And it's very difficult to move them out of that supply chain.
What's your base case scenario for the U.S. economy under a Trump presidency? If immigration, if a lot of immigrants are actually pushed out of the country, does that hit productivity? Does it hurt some of the dynamics that the Fed also need to watch out? Yeah,
I mean, I think if you genuinely follow through on those migration policies and you say, we're not going to get new immigrants and we're going to throw out however many million people, that's absolutely devastating. Because, I mean, there's a lot of those people working in a lot of those lower income jobs. How do you displace that? I mean, we've seen a little bit of that with Brexit. When we stopped having so many people coming in from Europe, and then actually, well, there's lots of places, agriculture, care homes, all the rest of it. How do you staff those places? And then you have to bring people, so I think that could be really, really negative if you genuinely follow through on that. But again, it's a question of, is it rhetoric, what we actually will be able to do?
But we know, I mean, what do we know, actually? I mean, do we know that Donald Trump looks at bond prices, and so inflation could be kept in check if it changes how the Fed will behave?
I mean, I think he certainly looks at equity prices, doesn't he? Because he's always talking about, the market has done so well. So I think if we see, as we saw in 2018, where we had big tariffs coming through and the market went down, 20%, I think that might get his attention. That might be the moment in which either the Fed would have to do something or he might actually have to put on the brakes a little bit.
Anything else that you're watching for? I mean, in terms of Fed, is it not automatically, but is there a higher chance now that interest rates stay higher for longer?
Yeah, I think that would be our general assumption, because I think, the potential for Trump is definitely inflationary. Plus, you've got an economy which, the debate all year has been, is it going to be a soft landing? Well, I don't think anybody's having that debate anymore. Everybody's pretty certain it's a good economy in the US, and therefore you probably don't need to cut interest rates significantly from here. Maybe another quarter point, but frankly, not a great deal more than that.
Okay, Charlotte, thanks so much, as always, for your insight. Charlotte Ryland, they're head of investments at CCLA Investment Management. Coming up, Tehran is expected to hold nuclear talks with the UK, France, and Germany this week for the first time under the new president of Iran. We discuss what to expect ahead of Donald Trump returning to the White House. That's shortly, and this is Bloomberg. Welcome back, everyone. Now, Iran expected to hold talks about its nuclear program with the UK, France, and Germany. The European Union is set to mediate the meeting in Geneva today. So let's bring in Bloomberg's news director for the EMEA region, Ros Matheson. Ros, thank you so much for joining us. First of all, talk to us about these Iranian nuclear talks and what we can expect. Are they a big deal?
Well, these are the first conversations, it seems, since the Iranian president took office back in July, but we don't know how high level they are. It seems to be at least officials, possibly ministerial, but certainly obviously no higher than that. And a whole lot of things on the agenda, as you say, Iran's nuclear program, but also, individual sanctions on Iranian shippers, on airlines, plus, of course, the ongoing conflicts, that we see in Gaza and also with Hezbollah in Lebanon. And so there seems to be a lot on the table and a lot of generic conversation, perhaps, that will come as a result. And it might be also that Iran wants to use this meeting to, sound out Europe about the incoming US administration, because really for Iran, the very big deal here is, what is a Donald Trump administration going to mean for the relationship? Is there any prospect at all of ever reviving, the nuclear deal that Donald Trump nixed in his first term as president? So perhaps sounding out European officials on that, perhaps even sending a message through European officials to the US on it. You wouldn't expect to see tangibles from this particular meeting. Again, there's so much on the agenda and the officials don't seem to be particularly high level. But interesting it's happening now, and interesting to see what happens behind the scenes in terms of messages that may be exchanged.
But so, Ros, is Europe actually de facto possibly becoming some kind of mediator?
Well, certainly we know that the French president, Emmanuel Macron, has often fancied himself as a mediator on the Iranian issue and had some limited success on that front. But certainly Europe will be worried about the prospect that a new administration in the US goes even harder on Iran. We can see that, obviously a risk that, does Donald Trump give Israel permission, for example, to come harder at Iran directly, perhaps even targeting some of Iran's nuclear facilities? And does he give them leeway to do so? And does that risk a broader conflict in the region? So suddenly there's an interest for Europe to be in this conversation and be trying to keep things on a measured keel, particularly again with the incoming US administration. So we're not going to see a resumption of the nuclear deal. That seems to be very, very unlikely, but at least can Europe help manage the relationship in the region and with the US?
Ros, what do you make of the threats, the latest threats from Vladimir Putin, saying that he could strike Kyiv with this new ballistic missile?
Well, there's a lot of bluster from Vladimir Putin on this front yesterday. I mean, this missile was used for the first time in a less concentrated area around the city of Dnipro. It's only been used once that we can see so far. Using it against a densely populated area like Kyiv would be a very big escalation. I mean, in part, this is quite a significant missile for Vladimir Putin. The stakes would be high because if the missile's intercepted, you know, it's an embarrassment for him. If it gets through, the damage it could cause would be significant. And obviously it comes against this backdrop of US-made missiles now being fired into Russia, UK-made missiles being fired into Russia, in the sense that things are escalating between Russia and Ukraine, and probably escalating because, again, they're trying to get themselves into a position to be, you know, best placed to negotiate from a position of strength. But quite a lot of conversation from Vladimir Putin about this missile. We don't know much about it. Again, it's only been used once that we can see so far.
Roz, thanks so much. Roz Matheson there with the very latest on geopolitics. Coming up, how the Trump trade could impact fundamentals. We deep dive with Bhanu Baweja. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. These are your top stories. France's Marine Le Pen makes further demands to the budget after the Prime Minister makes a major concession as the government's survival hangs in the balance. The yen strengthens, breaching 150 against the dollar as traders position for a possible rate hike from the BOJ next month at the same time as a cut from the Fed. And reports also suggest that Iran will hold talks on its nuclear program and uranium enrichment plans today with European nations. Now, the dollar is heading for its biggest weekly loss since August as investors start to rethink the so-called Trump trade that has driven gains in the currency since the U.S. election. Now, the rally has stalled on Donald Trump's promise of more tariffs and the nomination of Scott Bessent as the next U.S. Treasury Secretary, pushing down at U.S. yields. Now, for more, we're joined by Bhanu Baweja, Chief Strategist at UBS Investment Bank. Now, actually, the truth is that Bhanu and I catch up from time to time at events, and I've been wanting to invite Bhanu for like a good 15 minutes to try and understand really what's going on underneath the hood. First of all, Bhanu, talk to me about inflation in the U.S., because this is one of the big things that, you know, we know that swung the election. Is it the price of eggs and milk that makes a difference? If you look at, you know, Fed expectations, inflation is going down.
And inflation should go down, right? In the last couple of months, inflation's gone up a little bit because of certain volatile items like apparel, right? But our view is that our view is that the U.S. economy is going to slow down. Let me just pause there, because that is important, because most people feel, and the markets feel, that in the next 2 years you're going to get the same growth as you've got in the previous 2 years. That's what's priced into real yields for the forwards. That's what's priced into revenues. That's what's priced into earnings. We disagree. We think growth is going to go from high twos, probably close to 3%, down to the mid ones, 1.6, 1.7. So real growth. Also a pretty large drop in nominal growth. And that's why we think inflation is going to decline. So by the end of 2025, we do think it's going to go back to core PCE of about 2.1%. So that's very close to the Fed's target. So some of this recent pickup in inflation, we don't think this is a re-acceleration. Tariff inflation, yes, but there are large bands of uncertainty, not just in terms of the magnitude, but more importantly, Francine, in terms of the timing. We think this is a late 25, 26 hit to to inflation, and especially on core CPI.
But I mean, is this, even if we don't have some Trump policies that could be actually against the U.S. economy? So are you seeing a slowdown in GDP regardless?
Yes, absolutely.
Right.
So again, we should just pause to think. In the last 2 years, the U.S. has growth at an average 5.5, 5.6% in nominal GDP terms. That's a very high rate of growth. We've got to ask ourselves, and we've had this debate, is that driven by productivity? Because if it is, then you're going to see that continuing. But if it's driven by more old-school, banal factors like fiscal, like immigration, some of which could be reversed, then this should step down. And our view is the latter. We think it's going to step down as a result of that. So, yes, so there's an organic slowdown coming, irrespective of these Trump policies. We tend to look at the world only from a political lens, which I think is a mistake. You've got to look at where we are in the economic cycle as well. Yes, policies do make a difference, but there's a certain sort of life of the economy of its own, early cycle, mid-cycle, late cycle. Feels we are quite late cycle, and the U.S. consumer real disposable income growth has been slowing down, and that as a result result of that, consumption should slow down. It's been a consumer boom. It's not been a capex boom. Had it been a capex boom, I would have been more partial to the view that maybe productivity is coming. But because it's just been about consumption, you look at Walmart, you look at many of the stocks, you look at Costco, these stocks are making new highs. But in the lower half of the economy, things are much weaker.
So, Bhanu, what do you do with Trump policies? And again, I mean, we had a pretty robust debate on actually productivity versus immigration. The one things that we're hearing from the Trump administration before they even get into power is actually they will really focus on immigration and getting rid of the immigration that they don't want. So that could hit actually the economy quite fast.
Indeed. And so that worsens the growth inflation mix. Over the medium term, it creates inflation. So there are 3 or 4 industries: food processing, construction, leisure and hospitality, agriculture. In these industries, you get a lot of migrants, right? Both documented and undocumented. So you'll have to watch the wages in these 4 industries in particular, right? And I think that is medium-term inflationary, but you will see the growth hit straight away. So I think slightly, relative to the counterfactual, slightly lower growth, slightly higher inflation, but nonetheless, nominal GDP comes down.
What about deregulation? I mean, again, there's kind of this idea, which is frankly priced in some of the equities, which with the Trump administration, it's deregulation, the animal spirits are back, and maybe you get that capex.
So that's really important, Francine, right? So at this minute, if you look at capex, and we've had one data point since Trump has been elected on the NFIB. So I'm going to watch more the small businesses, right? Small and medium businesses, because they're very large employers, and that's where capex has also been quite weak. You've seen a little bit of a pickup in NFIB out there. Usually when you get a Republican government, NFIB goes up. You get a Democrat government, NFIB goes down. So you normalize for that political noise. But if you look through that, there's been a very modest pickup in the NFIB. So my suspicion is that you're going to, again, when you look at the regional capex surveys from Richmond Fed, Philadelphia Fed, all of this, they are actually telling you that, along with the ISM, they're telling you that orders are very weak and you're not seeing a very big pickup. So again, a consumer story. If deregulation can spur capex, I'm skeptical. I'm skeptical because, again, I don't think many long-term sort of investors in the real economy, I'm not talking about the stock market, feel that this is a great time to be putting in a lot of capital. So I'm struggling to see huge signs of the reindustrialization of the U.S. I think this has been a cyclical boom helped by immigration, helped by a positive labor supply shock. So I'm skeptical that we will see a very big pickup in capex over the next 2 years. But again, that's the space to watch. Capex intentions in the NFIB and all the regional feds, they will tell us that. Right now they're telling us over the next 6 months, there's no real enthusiasm yet.
But is there something structurally actually in the U.S. that goes through, when we look at cycles, we kind of tend to forget China. But does China factor into the thinking of a lot of then chief executives that have to spend in capex?
Yes. In terms of nearshoring, absolutely it does, right? So, I mean, yes, U.S. capex has been quite weak, but you look at Mexico's capex, that's actually been really, really strong. So there are some elements of nearshoring. By the way, the U.S. is not alone in this. The same thing happens in Europe as well. Don't just look at Germany's capex, also look at the Czech Republic, look at Hungary, look at Poland. So there is a lot of clear signs of nearshoring. So that's absolutely true. But are there signs of onshoring? I mean, are we seeing clear signs of domestic investment picking up in a big way? Are we seeing capex orders picking up in a big way? That just hasn't happened as yet.
But could we? So I've spoken to like 3 or even 4 very large cap European chief executives that were at pains in saying, we're going to put more in the U.S. because of maybe tax breaks, but also because they don't want to get on the wrong side of Donald Trump, frankly.
That's absolutely true. But if you're a large chief executive of a large company, of course you're incentivized to say that, but you don't make long-term decisions based on sort of a 4-year tenure of a president. You don't make structural decisions based on that. Many of these companies have been doing it anyway, right? Yeah. Japan has been doing it for a long time. Europe has been doing it for a long time. A lot of car manufacturing has shifted to the U.S. A lot of cap goods growth has shifted to the U.S. But again, there's also something to be said for policy by Twitter and how that actually increases rather than decreases uncertainty. Yes, on the one hand, you have deregulation, and deregulation may mean one thing that deregulation could mean is lower oil prices. That's a possibility, because if you deregulate the oil sector and if you take away quite a few of the regulations, then there's a possibility that you drill much more and therefore put more great pressure on OPEC. You enter into a price war, and that could lead, so lower energy prices could in fact spur even demand in Europe. Europe has such high savings, very unlike the US. Since COVID, they've had very high savings. sitting there, and you need a trigger for them to be unlocked. So one upside risk to many of our views is that, in fact, oil prices go to 55 or 60 in a good world, not because of a recession, but because of greater supply, both from shale and also from OPEC.
But if you're Mexico right now, if you're Canada, you're probably feeling the heat more than others. We heard from the Mexican president saying that she will retaliate, or she be tit for tat almost until everybody loses. We had another view from Christine Lagarde, which was questionable whether it's the role of a central banker, but she's saying, look, we have to spend more in the U.S. We should buy U.S. products instead of retaliate. I mean, does this actually make a difference in policies? Are we now psychologists to try and understand how much you're hit by tariffs?
It's again, if you were to think about this in a sort of game theoretic sense, it would be hard for me to see how global policymakers do not react to what is a very obvious threat. I mean, Lighthizer has been talking about this for an age, right? I mean, this has been, he's looked at the world from a sort of a mercantilist lens, and he has said that everybody's been cheating the U.S. Actually, if you look at Europe, and if you look at how Germany has almost been deindustrialized, there's a lot that you can see very clearly that China is gaining market share and Germany is losing market share. So there are many economies that could argue that you have to increase tariffs on China. But if you put it on the rest of the world as well, I think that will have a much more material impact on inflation in the U.S., a much more deleterious impact on growth in the U.S. Also because I think in that world, I cannot see how the markets hold up. I think Trump pays attention to the markets. That, for him, is his real-time monitor of his popularity and of the validity of his policies. I think global policymakers understand that, and therefore, just in terms of how they're likely to be thinking about it, I don't think they're going to sort of lie down and take it. So I think the risk of retaliatory tariffs is high.
So interesting. Bhanu, thank you so much. Bhanu Baweja, they're a chief strategist at UBS Investment Bank, stays with us. We'll talk a little bit more about Europe, UK, and maybe Japan. Plenty more to come. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now let's get a check on some of the individual stocks on the move today with Joe Easton. Hi, Joe.
So we are seeing some specific declines in companies that supply Brazil at the moment, Fran. We're looking at the stocks in Spain, Telefonica and Santander. These companies earn around 20% of their sales in Brazil. We are seeing declines in Brazilian assets this week due to concerns around the budget. A couple of other stocks here, AB InBev and Mapfre, the insurer, seeing the weakness. But I've really got my eye on these large cap Spanish stocks. Significant losses in those shares given Brazilian worries at the moment. Then there was another stock heading lower. Once again, it was Hugo Boss. We had a move in this one yesterday, around 8.5%. It fell. A potential probe into the CEO there. The company says that the CEO does comply with regulations. We're waiting for a comment from them ourselves, but we're seeing the stock down another 1%. Potentially heading for a big weekly loss for Hugo Boss on that stock. Then in terms of the M&A, Direct Line yesterday had that massive gain, around 38%, and we're still heading higher. The takeover bid coming from Aviva. Now the offer was at 2.50. We're still slightly below that. Potentially some people thinking it's a bit of execution risk on that one, but we're seeing a second day of gains for Direct Line, the UK insurance firm. Over in cosmetics, meanwhile, Deutsche Bank turning negative. More negative on L'Oreal, saying that the cosmetics firm is potentially seeing a weakening in sales heading into the Christmas period. So they cut their price target to a street low on the French company, and that stock is slipping today. Then a couple of really other analyst calls, really interesting ones that stood out to me. BAE Systems in defence. We don't see many sell ratings on this stock, but BofA downgrading it, and they're actually citing Elon Musk's new department, the Department of Government Efficiency, which they say will reduce defence spending in the US and therefore hit BAE and a number of peers. Then finally, Anglo-American over in the commodity space, seeing a rebound in a lot of the commodity stocks today, but also Jefferies has a buy on Anglo, saying that potentially the M&A situation is going to come back into focus. Remember, BHP tried to do a takeover, then had to walk away because it didn't go through. Jefferies reckons the situation has longer to run. They recommend you buy Anglo for that reason, and the stock is gaining 3% in London today.
Joe, thank you so much. Joe Easton there from our equities team. We're also both Chelsea fans, so we commiserate and celebrate at the same time, which kind of gives us a unique bond. Still with us, Bhanu Baweja, Chief Strategist at UBS Investment Bank. But do you follow football?
I do, and I'm not a Chelsea fan.
You're not?
I'm not a Chelsea fan at all. That's
but
it.
You're not walking upset, right? We're done. We're still talking about Trump.
5-1 to Arsenal.
We're big rivals then. Very big rivals.
Yeah.
But when you look at what's priced in the markets, and we're having this great conversation about what Trump trade tariffs mean for economies, and actually what is priced in the markets. I mean, there seems to be a mismatch, which you highlighted.
Right. So if you think first on growth, what's priced in is about 5 to 6% nominal growth, right? So just exactly what we have seen in the last 2 years. The markets are extrapolating that for the future. On taxes, one way to look at this is to look at 2026 earnings, because 25 is baked in the cake. The taxes are not going to make a difference. But 2026 earnings, both pre-tax and post-tax. And you can back out from that a tax rate, and that tax rate is 19%. So the market is, and in fact, even before the election was, pricing in a decline in taxes, right? Deregulation was not priced, but now given the rally in some of the drillers, given the rally in financials, you can say that that's increasingly being priced in. There's more to run out there. What is not priced, I think, is tariffs, right? So what the market seems to be saying is that all the good policies, lower taxes, deregulation, that's for us to take and run with. But tariffs is really just a negotiating tool that's not likely to happen, right? Maybe you're pricing in a little bit of tariffs in inflation break-evens in the fixed income market. So really some nooks and corners of the asset markets. But in the bigger markets, right, in the FX, in dollar renminbi, in dollar MEX, if you look at the skew of option volatility, dollar call relative to a dollar put, you're really not pricing in any risk premium out there. So it really seems that the market thinks that tariffs is bluster, which is a brave assumption. It's a brave assumption. Now, it is possible, we were discussing in the earlier segment, that if tariffs lead to a big drawdown in the market, Trump may rethink. But that then becomes the trade after the trade, because surely it takes a drawdown in the market for Trump to change his mind. So I don't think tariffs are being priced in the market. I think Trump's sort of market-enhancing policies, which is lower taxes, and also lower regulation, are being priced.
But I mean, I feel there's a lot that's not being priced in, right? If he goes after his political opponents, or actually business opponents, that weren't supportive of his campaign, does the market look through this? Or if he goes after big companies, is it going to lead to nervousness and jitters?
Well, it depends on what kind of big companies is going to go. So again, if you go and attack big companies, which are some of the big market cap companies, again in tech, I think that's undoubtedly a problem. The question is, how much is he going to do? Because J.D. Vance, his vice president, also has sort of good contacts in Silicon Valley and quite a few supporters out there. So it's not clear how much he's going to go after tech in a very big way. And also because he's not stupid, he can see that that's one of the places that has been driving both this productivity narrative and also the market, which is so dear to him. So it's not clear to me that he's going to go that hard. But if there is pursuit of many CEOs of large market cap companies, I think that will be a problem, right? To the extent that there has been, to the extent that he has set up, he's draining the swamp in his terms and set up his own people out there, including in the Supreme Court. The markets look through that quite clearly. They don't care, right? So I would imagine that if he goes after CEOs of smaller companies, I don't think that'll make a very big difference. But I think the question is tech. Does he go hard after tech companies in a big way? My base case would be probably not, because again, he's surrounded himself by people who are, Elon Musk and J.D. Vance and all these people. So it's hard to see how he goes after tech in a very big way. But if that changes, you have to change your mind.
But so China is a net loser in this. What about Europe?
Also a loser, right? Because, again, Europe is exposed to the global trading system. And unlike Trump 1, when global trade was actually pretty robust and Europe was doing quite well, 2017 was Europe's best growth year since the GFC. Europe's in a very bad place right now. We'll be lucky if we get 0.6% growth this year. And consumer sentiment is weakening. Germany's in a bad place. The difference between core and peripheral Europe is not very clear anymore. So Europe isn't in a very good place. Then you impact further, global capex spending and global trade through China. China's already been sort of responsible for taking market share from Europe. So Europe's pretty vulnerable right now. So this is not great for Europe. And in fact, that's why we feel that although Trump policies are not priced into the S&P, and that S&P will have to pay a price for that, the S&P is still likely to outperform Euro stocks. We have very modest returns, much below consensus returns for the S&P next year. We're thinking sort of 6% returns on the S&P, but likely flat returns in Euro stocks.
Okay, Bhanu, thanks so much, as always, for your great insight. Bhanu Baweja, their chief strategist at UBS Investment Bank, with a pretty, good and intense conversation on Trump trades and what it means for places around the world. Now, coming up, oil producer Norway takes the wheel and steers the country towards an EV revolution. We'll have the details next, and this is Bloomberg. Welcome back. Now, Norway on the cusp of completing a transition away from combustion engine cars, thanks to targeted incentives that make EVs an easy choice. Now, today's Big Take explains how the transition happened with remarkable speed. Carrie Lundgren, our energy reporter, has more from Oslo. Carrie, this is such an amazing story. You did a mini road trip for the story. How do the roads of Norway look now?
Well, it was a lot of fun. It was important to get out of Oslo because in Oslo you have about a 40% penetration of EVs. So in some ways you wanted to get out a little bit and see what it was like in the countryside, which is what I did. I went to an area where the penetration is closer to 3%. And when you're there, you're hearing people talking about things that you heard in Oslo 10 years ago. People saying, oh, I'm worried about the battery running out in the woods, or charger anxiety, range anxiety. But as you come in, you sort of realize that people are, that's kind of one of the biggest hurdles. And really, when it comes down to sort of those habitual things, people get over those, and you come into Oslo and suddenly people are quite happy to have an EV, do not have those same concerns, and it really comes down to the price of the vehicle. And if the price is right, if they can get an EV for less than they would pay for a fossil fuel engine, people are happy to do that, and that is what you have seen in Norway.
So, Kari, Norway hopes to have 100% EVs by next year. Will it get there?
I think there's a good chance that you will see some months where the sales are 100% EV sales. It'll go up and down a little bit. And of course, one of the things Norway has done, which is quite important, is this isn't sort of a flat-out ban. It's not that as of next year you cannot buy a fossil fuel car. I think that's really important because there are people that are hesitant or for whatever reason may want a fossil fuel car. And by doing it this way, Norway has really kind of depoliticized it. It's made it a personal choice, which is often coming down to economics, as I said before.
Kari, thanks so much. Kari Lundgren there, Bloomberg energy reporter. It's one of my favorite, actually, big takes. So I urge everyone to go and find it on the Bloomberg terminal, or also we'll push it out on our website. Up next, Bloomberg Brief, Manus Cranny in New York, and this is Bloomberg.